It was a Tuesday, the kind where the rain outside mirrored the gloom inside Liam's tiny apartment.
He stared at his phone, a notification from his bank app flashing a depressingly familiar number.
Another month, another paycheck dwindling, barely enough to cover rent and the ever-growing cost of groceries. Liam was 25, full of dreams, but also burdened by a lingering sense of financial anxiety. He'd heard whispers about investing in compound growth but dismissed them as jargon for the wealthy, something completely out of reach for someone like him, living paycheck to paycheck. Across town, his friend Sarah, also 25, felt a different kind of unease. She'd just finished a financial seminar, buzzing with talk of the eighth wonder of the world, compound growth. But it all sounded too good to be true, too abstract. Put a little money away, wait 30 years, and it somehow multiplies?
Her instinct screamed scam or too slow to matter. She wanted to buy a house now, travel now. The idea of deferring gratification for 3 decades felt like an impossible ask, a cruel joke on her youth.
Was this really worth it? Liam and Sarah represent millions grappling with the same fundamental question: is compound growth over 30 years actually worth it?
In a world of instant gratification, where headlines scream about quick riches and overnight successes, the slow, steady drumbeat of long-term investing feels quaint.
Maybe even foolish. This isn't about getting rich quick.
It's about understanding a force so powerful it can transform ordinary contributions into extraordinary wealth, but only if you play by its rules. And those rules start with time.
Let's strip away the jargon and start with basics.
Imagine you lend a friend $100. With simple interest, they just pay you a fixed percentage of that initial $100 back each year.
Easy.
But with compound interest, it's different. Not only do they pay interest on your original $100, but they also pay interest on the interest that has already accumulated. It's like a snowball rolling down a hill, picking up more snow, getting bigger and bigger, faster and faster.
The interest earns interest, and that's where the magic begins.
Now, add time into this equation. If that snowball rolls for just a few feet, it doesn't get much bigger.
But what if it rolls for miles? What if it rolls for 30 years? This is the critical factor that most people underestimate. Compound growth isn't linear, it's exponential.
It starts slow, almost imperceptibly, but then it accelerates dramatically.
The first few years, your balance might barely nudge. But as the years turn into decades, the base grows so large that even a small percentage return translates into substantial gains. To grasp this power, let's look at a handy mental shortcut, the Rule of 72. This rule helps you estimate how long it will take for your investment to double, given a fixed annual rate of return. You simply divide 72 by the annual interest rate. So, if you're getting a 10% annual return, a reasonable long-term average for broad market indices, your money would double every 7.2 years. Let that sink in. Double every 7.2 years. Over a 30-year span, that's 4 doublings. Back to Liam.
Inspired by a friend's advice, he decides to dip his toes in. Starting at age 25, he commits to investing just $200 a month for 10 years, until he's 35.
After that, he stops adding new money, letting his accumulated sum grow untouched until he's 65.
It's a small sacrifice for a decade, but he's skeptical.
Is $200 really going to make a difference?
At a conservative 7% annual return after inflation, more on inflation later, his initial investment feels almost insignificant for those early years.
He can't see the future forest for the present saplings. Sarah, meanwhile, waits. Life happens. She prioritizes travel, a new car, enjoying her youth. It's not until she hits 35, a full decade after Liam started, that she finally gets serious.
Recognizing lost time, Sarah decides to be more aggressive, investing $400 a month for the next 30 years, until she's 65.
That's double Liam's monthly contribution and triple the duration he actively invested. Intuitively, one would assume Sarah's larger, longer contributions would inevitably lead to a far greater outcome, right? This is where compound growth plays its first trick. Let's compare Liam and Sarah, both aiming for age 65.
Liam invested $200 per month for 10 years, total $24,000. Sarah invested $400 per month for 30 years, total $144,000. She put in 6 times more money. Yet, assuming a 7% real annual return, Liam's portfolio at 65 would be roughly $304,000.
Sarah's? Around $300,000.
Liam, who invested far less money for a much shorter period, ends up with virtually the same amount.
This isn't a fluke, it's the fundamental power of time and early compounding. But where does this return come from? We're not talking about guaranteed bank interest rates. We're talking about investing in the broader economy.
Historically, a diversified portfolio tracking the S&P 500 has delivered around a 10% average annual return before inflation.
This isn't a prediction, but a reflection of how the largest 500 U.S. companies have grown over decades. This robust engine of innovation, productivity, and profitability is the bedrock on which compound growth builds its formidable structure. Now, a crucial reality check: inflation.
While the S&P 500 might average 10% annually, a significant portion of that gain is eaten away by the rising cost of living.
Imagine that $100 today.
In 30 years, due to inflation, it won't buy $100 worth of goods. Historically, inflation averages around 3% per year. This means your real rate of return, what your money can actually buy, is closer to 7%. We used this 7% for Liam and Sarah's examples to reflect a more realistic purchasing power.
Ignoring inflation is one of the biggest mistakes beginners make. Even with solid returns, many investors underperform the market. Why? Because of emotion.
This is known as the behavioral gap. When markets dip, panic sets in, and people sell, locking in losses. When markets surge, FOMO, fear of missing out, kicks in, and they buy high. These emotional decisions, chasing returns or fleeing fear, consistently erode long-term gains. Over 30 years, markets will have many ups and downs. Staying calm and consistent is harder than it sounds, but it's absolutely vital for letting compound growth work its magic. To combat the behavioral gap and market volatility, savvy investors employ dollar-cost averaging, or DCA. This strategy is beautifully simple: invest a fixed amount of money at regular intervals, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more shares. Over time, this averages out your purchase price, reducing the risk of making one large, ill-timed investment. It takes the emotion out of the equation and forces discipline, turning market dips from a fear into an opportunity.
Another often overlooked boost to compounding comes from reinvesting dividends.
Many companies distribute a portion of their profits to shareholders as dividends. Instead of taking that cash, you can automatically use it to buy more shares of the same stock or fund. These new shares then earn their own dividends, which are also reinvested, and so on. This creates a powerful mini-compounding engine within your portfolio, silently accelerating your growth over 3 decades.
It's like adding tiny, consistent boosts to your snowball.
One of the biggest psychological hurdles to 30-year compounding is the valley of despair, the first 5 to 10 years. Liam, checking his portfolio in his late 20s, often felt like it wasn't working. After contributing $200 for a few years, his balance might only be slightly more than his total contributions. The growth is there, but it's hidden in the early, flat part of the exponential curve. It takes immense faith and discipline to keep going when the numbers feel small. This is where most people give up, missing the massive gains that come later.
Fast forward to Liam at 35.
He's diligently invested $200 a month for 10 years.
Total contributions, $24,000.
His portfolio, assuming a 7% real return, has now grown to approximately $34,480. Not bad, a gain of over $10,000. But to him,
it doesn't feel like life-changing money. He decides to stop contributing, confident he's done his part, and focuses on other expenses. He'll just let it sit. Little does he know, the most significant growth is yet to come, silently working its magic behind the scenes. At 35, Sarah looks at her bank account. She's traveled, she's enjoyed life, but she has little to show for it financially. Liam's seemingly modest success inspires her, but she's frustrated she didn't start earlier. Feeling behind, she commits to a more aggressive plan, $400 a month. She believes her higher contributions will quickly catch her up, maybe even surpass Liam, given she'll be investing for 30 years straight. She feels the pressure of lost time, pushing her to contribute more to compensate. Let's fast forward to when Liam and Sarah are both 50. Liam, who stopped contributing at 35, has seen his $34,480 grow to around $96,000. He hasn't added a dime in 15 years. Sarah, who started at 35 and has consistently invested $400 per month for 15 years, has contributed $72,000. Her portfolio value is now approximately $110,000. She's ahead, but considering she put in almost triple Liam's total contributions, the gap isn't as wide as she might have hoped. The early momentum of Liam's small sum is still a powerful factor. This is where the magic truly unfolds. The later stages of a 30-year compounding journey are where the exponential growth becomes undeniable. The initial valley of despair gives way to the exhilarating hockey stick curve. The balance grows so large that the annual percentage return, even if it's the same 7%, translates into tens of thousands of dollars in growth each year, sometimes even more than your entire annual salary. This is the payoff for patience, discipline, and letting time do its heavy lifting. Finally, Liam reaches 65. He hasn't touched his investments since he was 35, merely letting the $34,480 he accumulated compound for another 30 years. His total contributions were only $24,000. Yet, his final balance stands at approximately $304,000. He put in a relatively small amount for a short period early on, and then simply waited. Most of this growth, the vast majority, happened in the later years, driven by the interest earning interest on an ever larger base. This is the silent power of starting early. And Sarah? She reaches 65, having diligently invested $400 a month for 30 consecutive years. Her total contributions are a substantial $144,000. Her final portfolio value is approximately $300,000. Yes, she reached a significant sum, but look at the cost. She invested 6 times more of her own money than Liam did, yet ended up with slightly less. Her late start meant her money had less time to compound in those crucial early decades, where the interest on interest truly builds momentum. Here's the aha moment: the real magic of compound growth over 30 years isn't just about the final number, but how you get there. Liam's story isn't about investing more, it's about investing sooner. His $24,000 contributions, starting early, grew exponentially, needing little more effort from him later. Sarah, despite pouring in $144,000, struggled to catch up because her money missed out on those critical initial compounding cycles. Time, not just money, is the most powerful ingredient in this recipe for wealth. The principle of compounding isn't limited to money. Think about skills. Learning a new language, practicing an instrument, or mastering a professional skill daily, even for a short period, accumulates over years. Each new piece of knowledge or ability builds on the last, making future learning easier and results more profound. Similarly, positive relationships compound. Small acts of kindness, consistent communication, and mutual support build trust and connection that deepens exponentially over time. It's an investment in yourself and your network. So, is compound growth over 30 years actually worth it? The answer is a resounding yes, but not just for the final dollar amount. It's worth it for the peace of mind, the increased choices, and the freedom it offers. It's worth it for knowing you've built a safety net, for the ability to pursue passions without financial stress, and for leaving a legacy. It's about taking small, consistent steps today that compound into a vastly different future, one where you dictate your terms, not external circumstances. For those of you, like Liam and Sarah, who are still standing at the crossroads, wondering if it's too late or too small, remember this: the best time to plant a tree was 20 years ago. The second best time is today. Start small, be consistent, and most importantly, start now. Even $50 a month, consistently invested, will be a powerful force over 30 years. Don't let the valley of despair or the lure of quick gains deter you. Trust the process, and let time work its magic.